Okay, class, good morning. We are going to be starting now. And so this morning, we are going to start with May 2023 diet question. On Thursday, we solved that of May 2020. Let me see. Yeah, we started with November 2023. So today, we are going to start with that of May 2023. So again, in your exam, this might be your question one in the exam. Immediately run through the requirements of the question. And that's the first thing we would look at. And it says, prepare for Adama PLC the following financial statements: statement of profit or loss and other comprehensive income for the year ended June 30th, 2022. Statement of changes in equity for the same period, and a statement of financial position as of June 30th, 2022. Okay. I would pay particular attention to the reporting date. The reporting date here is June 30th, 2022. That means the beginning of the year would be July 1st, 2021. I would pay attention to that. I will immediately establish that in my mind. And the reason is that in case there is a transaction happening during the year, like in December, for example, I will know that, okay, this is a transaction during the year that might need that I would have to prorate, especially for depreciation, if need be. So I would pay attention to the year end. I know the year end is June 30th, 2022. Now, I've established what the question wants me to do, and I know that they want me to prepare those statements. Of course, you would be given a trial balance at the year end, of course, which is June 30th, 2022. Again, I will pay particular attention to this level of rounding off is in thousands. I will note that because I need to carefully express that in my solution. I'll quickly just glance through the trial balance. It's not like I'll be looking at it item by item. I'll just glance through and ensure that my trial balance balances, because it goes a long way to show how your statement of financial position would look. If your trial balance is not balanced, your statement of financial position will never balance. And I told you that when you have a trial balance, the items on the debits are majorly assets and expenses. The items on the credits are share capital, reserves, that is equity, income, and liabilities. Those are the items you would find on the credit of your trial balance. And I told you that they would, of course, give you additional information that, assuming that you don't know how to adjust any of these items in the additional information, you must still attempt this question, because all you need to do is just to present each of these items in the trial balance. Each of them, present them where they belong in each of these statements. Out of the marks that will have been allotted, around 25 marks to this question, you will have gotten almost half of that, almost half. But you will see, as we look at this additional information today, you'll find some things we have seen in the last one we solved that you should be able to at least exempt, if not all, at least majority of them. Now, don't forget that the items in the trial balance, they have already passed their double entry. They have passed their double entry. So all these items in the trial balance, you just need to treat them once. Just present them where they belong. Just once where they belong. The items in the trial balance, they have passed their double entry. These are ledger balances. Now, the additional information, what it wants to do majorly is that it's just giving you what has happened at the end of the year. Majorly, most of them might be updates to what is in the additional information. So you'll find that the figures in the additional information will either increase the figures in the trial balance or decrease it. That's the effect. Majorly, it increases it or decreases it. Additionally, the items in this additional information might just be new transaction. And when they are new transaction, it simply means that you would have to see them as new and treat them as new transaction in the statement. But ultimately, all these items, there are 10 additional informations here. You have to treat them twice because they are new transactions, they are updates that has not been incorporated in the books. So they will always have dual effects because it's a new transaction. So let's pick them one by one. I'll run through it and see which one I know and which one I don't know. I'm putting myself in your shoes now. So the first one says the value of the field, land, and building includes a land element of 266.8 million, and the estimated remaining life of the building at July 1st, 2021 was 25 years. Depreciation on building is charged 65% to cost of sales and 35% to admin. Okay, so everyone should know how to adjust for this now because this is just depreciation. Secondly, they said the revenue includes 69.2 million for an item of office equipment disposed in November. The equipment had a carrying value of 46 million at the date of sale. The equipment cost 75 million when it was acquired 3 years ago. Okay, this is something new, and we would see how to treat that very soon. The third one, they said, included in cost of sales is 82.6 million incurred in the manufacture of a new office equipment, which was put to use by Adama PLC on February 1st, 2022. Okay, so they included something in cost of sales that obviously should not be there. Because how can you manufacture a new office equipment and add it to your cost of sales? And this happened on February 1st, 2022. Of course, I'm already noting these dates because the year end is June 30th, 2022, and this happened on February. So majorly, some progression might happen if I have to calculate the depreciation, but we'll get there. Fourth, all office equipment is depreciated at 15% per annum using reducing balance, okay, and charge to cost of sales. While depreciation of all motor vehicles is at 20% per annum on straight line, okay, and charge to distribution cost. Depreciation is to be charged in full in the year of acquisition and no charge in the year of disposal. This sentence is powerful, is extremely powerful, saying that depreciation is to be charged in full. Depreciation is to be charged in full in the year of acquisition and no charge in the year of disposal. What this shows you is that even if you acquire an asset during the year and you need to charge depreciation, don't prorate that depreciation, because depreciation is to be charged in full in the year of acquisition. Don't prorate your depreciation. And in the year you are selling an asset, don't even charge depreciation at all. In the year you are selling an asset, don't charge depreciation at all. Note 5. Following the conclusion of winding up proceedings on one of Adamant's PLC's customer, it was resolved to write off the sum of 26.4 million from the customer and to make allowance for doubtful receivables of 2.5% on the continued trade receivables. So this is talking about bad debt and allowance for receivables. We should see how to adjust for that. Note 6, the financial assets are equity instruments held at fair value through profit or loss and have suffered impairment loss of 12.7 million at the year end. At the year end. Note 7, the 3% redeemable loan notes were issued. The 3% redeemable loan notes were issued on October 1st, 2021 under terms that provided for a large premium on redemption in 2005. These terms were interpreted by the finance director to mean that the loan note have effective interest rate of 6.5%. Okay. So this one also is nothing new, because this has to do with financial instruments, and majorly you will see what you will need there very soon. Note 8, the income tax expense for the year ended June 30th, 2022 is estimated to be 143.5 million, while the deferred tax payable for the same period amounted to 12.5. There was an over provision of 25.6 in respect of income tax for the previous year. Okay, this one, when I saw it this diet, it was strange. It was very, very strange, because I mean, even the construct is wrong, is very wrong. They should not put over provision in the additional information. I will tell you, I will explain why very soon. But I mean, they have done it, they have done it. We have to solve it. Over provision or under provision is something that happens from last year. So it should be in the trial balance. So I'm surprised Ican decided to put it in the additional information for you, this particular diet, but we have to find a way to resolve it. But it was a wrong question construct for that particular diet, but we'll resolve it. Note 9, the suspense account balance represents the corresponding credit entry for shares issued at premium of 15 kobo per share, arising on issue of 400,000 ordinary shares made during the year. Okay, so this was similar to the one of May 2023. No, the one of November 2023. There was an additional information like this there also. They also said the directors recommended a 20 kobo final dividend per ordinary shares for the year and to transfer 38.9 million to general reserve. Directors' recommendation of dividend does not automatically mean you need to make provisions or accrue for dividend. No. Yes, directors recommend, but the point where you can recognize dividend is when shareholders have approved. So this information, you will just ignore it, that directors recommended a 20 kobo final dividend. We will simply ignore it because it is not due for recognition at the point where directors recommended. They just recommended. Shareholders haven't approved. So as an accountant, you do nothing. You do nothing. Yes, they have recommended. When they do AGM, then shareholders would approve. And then it will be due for recognition afterwards. And of course, there was a transfer to general reserve. I mean, where are we transferring from? That's the key thing here when we are transferring to general reserve. Of course, it's becoming from retained earnings. You can only transfer from general reserves to your retained earnings. Okay, so if I were you, that is what I would do in the exam first. I would quickly run through this question, having in mind that this question, depending on the number of marks allotted, I didn't put it there. I know I won't have at least around 45 minutes to, it's not like I want to spend the whole of my time on this particular one. So I already know the ones I can adjust and the ones I cannot. An average student of equity should be able to adjust almost everything here because there's nothing serious here. So let's pick them one by one. So now I didn't go back to additional information one now. I want to start updating. Like I told you in the last class, don't engage in the practice of leaving space. Don't leave space. That's not how Ican exam is marked. Nobody cares about final answer. It's really what you do. It's your methodology, your arrangement that really matters. Your steps. So don't leave space that, okay, this first page is where I would do my statement of profit or loss. This second one is when, just start from the first page. Label the question you want to solve. It is 1A, write 1A. They will have told you 1A. Write your workings, write workings. Then you start your workings. And nobody says you must do workings 1 before you do workings 2. No. What is important is each of these additional information have an item they are dealing with. Label it correctly. Like this first one now. They said the value of freehold land and building. So you know that this additional information is talking about land and building. So you label workings 1, freehold land and building. Then you do whatever workings you want to do for that. Then you move to the next one. Systematically, step by step, do what you have to do. Then move on. But every minute counts in the exam. So let's quickly look at this. So the value of the freehold land and building includes land elements of this amount. Okay, and the estimated remaining life of the building as at July 1st, 2021. So this July 1st, 2021, I know that that's the beginning of the year. So the useful life of the building is 25 years. You will see that they didn't bother giving me useful life of land because in reporting, land has an unlimited useful life and we don't depreciate land. We're now told that depreciation on building is 65%. Charged to cost of sales, while 35% is charged to administrative expenses. So they are telling you that when you compute your depreciation, 65% of that depreciation, you take it to cost of sales, 35% you take it to admin. So this is quite straightforward. So let's quickly do that. So in my trial balance, I quickly get what is the value of my land. So they gave me freehold land and building as at the beginning of the year. This is 1st July 2021. So this is the cost of my land and building. So this is the end of the year. So this is the beginning. So this is the cost of my land and building. So I get the cost of my land and building. I go to my workings, solution, workings. Yeah, I put it as notes. You can put it as workings in the exam. So I label it number 1. Freehold land and building. And please, class, don't joke with this. Don't. It's very important. Level of rounding off. And I told you in the trial balance, the level of rounding off used is what you should use, right? And be coherent with it. So I put it there. So the cost of this land and building is 1,065,600. That's it. Then I know that this amount includes land. So like I did it in the last class, I can decide to separate the land. But I see that there was nothing on the land. The reason why I separated it in the last one was because I saw that they revalued the land. So I needed something separate to show the revaluation surplus on the land. But here now, the land is just there. It's just there. There is really nothing more to do with it. It's just what it is. So I don't really have to waste space separating it. So I know land is inside here, and I know I will not depreciate it. So first, I would remove my accumulated depreciation brought forward. In this case, it was zero. It was zero. And it wasn't like the asset was acquired this year. It has been acquired long time ago because I knew it was zero because they didn't give me, look at, these are my addition, my accumulated depreciation. They only gave me accumulated depreciation on office equipment and on delivery van. They did not give me for land and building or for building to be specific. I'll come to why very soon, but they didn't give me, there's really nothing I can do. So I put it here as zero. Then my depreciation charged for the year. So I carefully get my costs of the land and building. I put this here. I removed the cost of the land because I know land is not depreciable. I remove it. Then I divide it by the useful life, 25 years. Then I get this figure. Okay. Now, what you should note here is this. You see, this question gave you useful life. When it gave you useful life, to calculate depreciation is just the cost divided by the useful life, or cost minus residual value divided by useful life. That's how you calculate depreciation using straight line method, since they gave me useful life. In the last question we did, they gave us depreciation rates. When they give you depreciation rates and they say that you should apply the depreciation using straight line method, I told you, you just apply the depreciation rate on costs. On costs. That is all you do. You apply it on cost. But here they give us useful life. You divide the cost by the useful life. So take note of those difference. So this 266,800 is the cost of the land. So we have gotten our depreciation charged as this. Then my carrying amount will be the cost minus accumulated minus depreciation for the year will give me the carrying amount of this land and building. The question told me how I should allocate the depreciation. The question says that 65% of the depreciation should be charged to cost of sales, while 35% should be charged to admin. I do that. I get what go out of this amount. 20,769 goes to cost of sales, and 11,183 would go to would go to my administrative expenses. And don't forget, the question already gave me the cost of the land elements here in the additional information. So that's where I know, okay, which portion is the land element here. So, and they gave me the useful life here. They gave me how I should allocate my depreciation here already. So everything is in this additional information. Okay, so now if we were not giving useful life, if they didn't give you useful life, then they will give you a depreciation rate. Okay, they will give you a depreciation rate. And when they give you a depreciation rate, listen up, please. They must tell you whether you should use straight line or reducing balance. They must tell you. In this case now, they didn't tell us when they give you when they give you useful life, they won't tell you whether you should use straight line or no, they won't tell you, because immediately they give you useful life, you must use straight line. You cannot use reducing balance. So that's why the examiner, you will see, they didn't tell us, they just give you the useful life of the asset. You have to use straight line. And it's very straightforward. Cost divided by the useful life. The only reason we deducted land is because land is not depreciable. And the figure they gave us in the trial balance already includes land. So we need to remove the cost of the land so that whatever is remaining is the cost of the building divided by the useful life. And that ends there. But if they have given you depreciation rates, the examiner will tell you whether you should use straight line or reducing balance. And I've shown you the two dynamics in the last question. If it's straight line, that means you apply the depreciation rate on costs. If it is reducing balance, that means you apply the depreciation rate on the opening carrying amount. You will still see it again very soon. That's the additional information one. If this is going to come out this diet, you need to be able to adjust for all of these ones, this depreciation. You need to be very comfortable with it. And of course, you need to understand the essence of this. In all of this we have done, this depreciation here goes to P or L, and the examiner is magnanimous enough to tell you where they should go. He has told you 65% of it should go to cost of sales, 35% of it will go to admin. They will always tell you every diet where you should take your depreciation to. Is either they tell you you take it to cost of sales, or they tell you you take it to admin, or they tell you you take it to distribution. That's one. Two, the second leg is this carrying amount. Not really the second leg, is this carrying amount is what you will take to your statement of financial position as the value of this freehold land and building. So this is the value of the land and building at the end of the year. Okay. If there are no questions, let's move to additional information two. So if they are silent, then you're free to take it to wherever you want to take it to. Of course, either cost of sales, admin, or distribution. I would advise you take it to admin. It's popularly in admin if the examiner is actually silent. But the thing is that in all of the diets, they have always told you where you should take it to. It has, yeah. Okay. So, any questions before I move on to the next additional information? You know, you are free to talk whenever you want to. Of course, after raising up your hand. Okay. Charles, you can go ahead, please.
Yeah, so if we were given accumulated depreciation on building, we just have to just put it there, that place, right?
Again, sorry.
If we were given, in the question, we weren't given accumulated depreciation of building. We were given only on office equipment and the other ones.
Yes.
So that was why none were added there. If we were given accumulated depreciation on building,
You will
we're
have
going to put it
removed it. Yes. You will have removed it.
there. Okay,
Yes.
thank you very much.
You're welcome. So, here. So, thank you for reminding me. I mean, out of curiosity, it might help you in some other part of the question. Why were we not given accumulated depreciation, the opening accumulated depreciation? And it's not like they bought this asset this year, because they didn't say cost. In fact, they didn't tell us they bought this asset this year. You know, if they have bought it this year now, then we will not expect that we'll have accumulated depreciation brought forward, since they just bought it this year anyways. But this one, they didn't buy it this year. Why are we not having accumulated depreciation? I mean, out of just further knowledge, for this question is not relevant. You don't have to start thinking about that. Don't stress yourself for this question. But, I mean, you're going to write FI exam in a few days to come. Why were we not given? Why is it not there? Anybody?
Maybe the asset is just newly revalued.
Thank you very much. Correct. Correct. Yes. So the asset was newly revalued, and it's very clear here. This freehold building is at valuation, right? Okay. So Latif, you said the asset was newly revalued. So yes, you're correct. That's why accumulated depreciation is not given. So I mean, why again? Why is it that when an asset is newly revalued, you will not have accumulated depreciation brought forward? Anybody?
Let me try.
Go ahead.
Okay, maybe they have been has been deducted previously before the revaluation.
It has been deducted before you arrive. No, that is not it. That is not it.
Hello, sir.
It has been
Because
fully depreciated.
No, that's not it. Olakunle, go ahead. You raised up your
Okay,
hand.
sir. Good morning, sir.
Good morning.
Okay, so it's assumed that when you revalue an asset, the initial cost has been eliminated. It now has a new cost, which is the fair value. And
Okay,
every depreciation that had happened in time past will be written off.
fantastic.
And so that's why it doesn't.
Thank you very much. Thank you very much. Yeah, that is the reason. And I've taught you that before, that when you revalue an asset, all the accumulated depreciation to date will be written off. I told you that, and we solved many questions on that when I was teaching you IS 16. When you revalue an asset, all the accumulated depreciation on that asset will be written off. Will be written off. And that is what is at play here. That is why we don't have accumulated depreciation on this land and building. Okay. Okay, so it's usually written off to revaluation surplus. Is one of the components that constitutes your revaluation surplus, right? Is one of the components that constitutes your revaluation surplus. So if you go and check how we arrived at it, when I taught you IS 16, you would see it further there, and it's better explained there for you. So we are not, it's not like, yes, written off means that we are recognizing it. And I mean the opening accumulated depreciation when you revalue. And it's usually written off to revaluation surplus. It's part of the component of your revaluation surplus. So we have looked at that before, but I mean the simplest form of it, right? The simplest form of it, because nobody will really bother you about where you're writing it off to, is that you just need to have the understanding that when you revalue an asset, it's like a rebirth of the asset. It's like everything about the asset is starting over again. Depreciation is written off. Depreciation is written off. There would be a revised useful life going forward. I mean, you're starting depreciation over again. That is why when you have evaluation model, it's always fair value minus subsequent accumulated depreciation minus accumulated impairment. Subsequent means that starting depreciation over again. Okay, so that's just by the way. In this question is not really relevant because they didn't give us, don't really bother about why they didn't give you. Now let's go to note 2. It says the revenue includes 69.2 million for an item of office equipment that was disposed in December. Okay, so Ijoma wants me to retake the accumulated depreciation. So again, when land and building is revalued, okay, or when any asset is revalued, it's like a rebirth of that asset. And all depreciation on that asset to date will be written off. You write it off. it will be cancelled out. And when you want to go deep into the double entry, you will see that it's usually written off to revaluation surplus. So I don't really want to bore you with that because I've not really seen any question that will really ask you to go deep into that. So I've already taught you that in IS 16, but the core idea is that when you revalue, it's like a rebate, it's like you're starting over that asset again. Depreciation is going to start newly, right? Majorly depreciation is starting newly over the remaining life of that asset. So accumulated depreciation will be written off. So that's why in this question, we don't have the accumulated depreciation. Okay, so which one again? Ijoma, I'm not getting your request. So you mean this one? Why we remove the cost of the land? Is because
Yes, in 266.
land is not depreciable. So,
Okay.
which is why we removed the cost of the land from the cost of the land and building. You see, this amount here is land and building.
Okay.
So the land component, you have to remove it so that what is remaining will just be the building. Then we divide it by the useful life to get our depreciation. Okay. So the next additional information, it says that the revenue includes is 9.2 million for an item of office equipment disposed in November during the year. That means they disposed it during the year. Okay, so the equipment had a carrying value of 46 million at the date of sale. The equipment cost 75 million when it was acquired. Okay, so how would you adjust for this in the exam? I mean, you just need to carefully look at it and be realistic, whether you know it or not. Be very realistic. And you have to be very careful not to just scatter everything. I mean, it's either you know it or you don't know it. If you know it, fine for you. You adjust the right thing. If you are not sure, I mean, why don't you just move to the next additional information and don't really mess up things very far. But in trying to always attempt, we can be very reasonable with it, right? Because looking at that, the fact that revenue includes this for an item of equipment that was sold. Okay, fine. So that means they sold an office equipment. Then they sold it for this. They now went to include it in revenue. You sold your office equipment. The money you collected, you went to put it in revenue. Should it be in revenue? No. Yes, you sold, but what goes to revenue is the consideration you received from the transfer of goods or services. The consideration you received from the transfer of goods or services. So as far as you are concerned, you did not transfer goods or services. You sold your assets, an asset that you use in production. When you sell that kind of asset, the money you receive doesn't go to revenue. It doesn't go to revenue. And it doesn't go to other income. Yes, you're very correct, Jennifer. You do recognize it from revenue. But I mean, where will it go to? It doesn't go to revenue. Where does it go? When you sell an asset and you collect money, that money you collect, where will it go? Thank you very much, Jennifer. Yes, it goes to disposal account. When you sell an asset that maybe you don't want to use that asset again, you now sold it, you now collect money. You debit bank, fine. You credit disposal account with the money you received. So you are going to remove this amount from your revenue. Take it away from revenue. Go and hang it in disposal account. I mean, If the only thing you know is the fact that you remove this from revenue, it will have added point to you. That's what will give you point. Remove it from revenue first. That will have given you point. You will see. They now said the equipment had the carrying amount of this. The cost is this when it was acquired 3 years ago. Okay. So they have given me the carrying amount of that asset that I sold. They have given me the cost. So how do you want to adjust this? What they gave you this information for is that, please listen attentively. Why they gave you this is that when you sell assets, there will definitely be a profit or loss on sale. Always, always. Anytime they tell you that they sell an asset, there would always be, you are either going to be making a profit or a loss. And here now, the profit or loss is always computed by comparing the carrying amount of the assets with how much you sold the assets. I mean, yeah, I don't even need the cost. They already gave me the carrying amount. So I don't need the cost again. What I need is this carrying amount. This is the carrying amount. And this is how much I sold it, 69.2 million. The difference here you will see is profit. I sold it more. So that profit is what goes to other income. Is the profit that goes to other income, not the money you receive.
Profit on disposal.
Yes. Is the profit on disposal that goes to other income, not the money you received. The money you received, you go and hang it in disposal account. The carrying amount, all of it, because you have sold the asset, you will have derecognized it from its asset state. You will have taken it away from your PPE. You will now go and put it also in disposal account, but you don't have to do all of that. Nobody's asking you to do that. I mean, all the examiner wants you to do in this note 2 is 2 things. Number 1, remove this amount from your revenue. Number 2, compute your profit on disposal or loss on disposal. That's it. Look at it. So I carefully write note 2. I know that this is talking about disposal of office equipment. I put my level of rounding off. I put it. I've already thought I've already really think through what I want to do. I know that first I need to remove this proceeds from disposal. I need to remove it from revenue. So I do exactly that. My revenue as per trial balance, if you check your trial balance on the credit side, they will have given you this. They will have given you this. I remove it from my revenue. So this is the balance of my revenue. Then in disposal account, this money I collected is in disposal account. The carrying amount there will be there. When I compare the two, I get my profit on disposal. I take it to other income. So let me go over it again. This question, revenue includes 69.2 million from selling an asset. No, when you sell an asset, the money you collected from the sale does not go to revenue. It goes to disposal account. So the first thing you need to do here is to remove this amount from revenue. It should not be in revenue. Secondly, the examiner gave us the carrying amount of that asset that you sold, as well as the cost of that asset. The only reason why they are giving you this is for you to calculate profit or loss on sale. Listen to me. Whenever you sell an item of PPE, you must get either a profit or loss on disposal. You must always calculate it, and it's straightforward. It's always the sales proceeds, the money you received when you sold, minus the carrying amount of these assets. And that's it. And that is all we did. So if this examiner wants to be really difficult and he wants you to go through a lot, he wants you to suffer for this mark, he will not give you this carrying amount. He will not give you. He will just tell you this. He will just tell you the cost of the asset is this, and it was acquired 3 years ago. And he will tell you the useful life of the asset. He will tell you the useful life of the asset. Again, out of curiosity, I mean, if let's say the examiner is wicked, right? And he now tells us that he says the useful life, I would remove this. I'm just trying to test you on something. He said the useful life is 15 years. I'm just doing something. So, and they didn't give us the carrying amount. They did not give you this. You see, because they gave us carrying amount now, it was very easy. All we need to do was just to get our profit on sale is to compare my carrying amount with my sales price. But let's assume the examiner didn't give us the carrying amount. They gave us the cost of this asset. They said it was acquired 3 years ago, and they gave us the useful life as 15 years. You would need to determine the carrying amount. What is the carrying amount?
The cost divided by 15 minus 3 years.
They want us to depreciate with
Depreciation. That's 75 divided by 12 years.
No, that's not right.
Cost minus accumulated depreciation.
We have to find the accumulated depreciation.
We have to find the accumulated depreciation.
That's
Then minus it
15,
from
that's
cost.
75 million divided by 15 years times.
I think he's trying to tell us we cannot chill, please.
Hello, I think 75 divided by 15 years, then the result should be multiplied.
Times 3
After we
years.
get times 3 years, which will give us the number of
The accumulated depreciation.
years, which we are going to now deduct from 75,000 to get the carry amount.
Thank you very much. That's correct. I think somebody has also mentioned that before. Yes. So the first thing I need to do is to get my depreciation per annum, which is 75 million divided by 15. This gives me how much? That's 5,000. This will give me depreciation per annum. Since I know that this asset was acquired 3 years ago, so I multiply it by 3 years. So that means that my accumulated depreciation is 15,000. So this 15,000 is my accumulated depreciation. Then I will remove this from the cost of the assets, right? And that will leave me my amount to be 60, right?
Yes.
60,000. So it is this 60,000 that I will now compare with my sales proceeds. Okay, fine. Okay, good. So whatever dynamics the examiner is going to bring, you should be ready. They have actually brought that before. In the diet before this, or I think upper one, and that was how they actually constructed it. Okay, so we are done with this one. So again, don't forget, in the exam, the sales proceeds, take it away from your revenue and get profit on disposal. So from all of these workings now, I know that, okay, I have a new revenue of this. And I know that I will not forget to put this profit, I will not forget to put it in other income. Workings 3 says that included in cost of sales is 82.6 million incurred in the manufacture of a new office equipment, which was put to use by Agama PLC on February 1st, 2022. Okay. We incurred 82.6 million. And we used it to manufacture office equipment, which I started using in February. And I'm putting it in cost of sales. No, it should not be in cost of sales. So all I need to do here is I need to remove this amount from cost of sales. That will have earned you a tick in the exam. Because you manufactured a new office equipment. It's not like it's not like office equipment is what I sell. if it's what I sell normally, then it's okay for it to be in cost of sales. But office equipment is part of my asset that I use in the business. So I should not put it in cost of sales. When I manufacture those office equipment myself, I should add it as PPE. Is going to be PPE. So all you need to do here is remove this 82.6 million from cost of sales. And you will tell them that it should be capitalized. That is all. Let me show you. So I go to my workings 3. I told the examiner, deduct from cost of sales, add to office equipment. You will see that, you should have noted that in all of these my workings, you will not find me anywhere doing debit this and credit that. Debit this and credit that. Of course, I could have done that. If I was doing this myself, I would have been displaying my debit and credit skills. But some of you don't go and do debit this, credit this. And eventually you go and you are doing what you should credit is what you are telling them to debit. What you should credit is the examiner will mark you bad. If you are not so very strong with double entry, don't even go there. Just have an understanding of, okay, am I deducting it? Am I adding it? That is sufficient. That is sufficient. If you see somewhere where they're doing debit credit, don't follow them. Oh, it's dangerous. So all I've told the examiner, the guy will happily mark me very well because he sees I understand what I'm doing. That okay, this thing should not be in cost of sales. I deduct it from cost of sales. Even though technically, as an accountant, you should know that means you should credit cost of sales. But this is exam. We want to pass first. When we pass, then we can improve on our knowledge. But pass first. So deduct from cost of sales. Then add it to office equipment. Even though technically, as an accountant, you should know that adding to office equipment means debit office equipment. But you will see in the exam, I did not do that. I'm just careful. I say add it to office equipment. And that is all I do. But this I will have gotten almost 1.5 marks. I go to the next one. This says all office equipment is depreciated 15% per annum using reducing balance method, and it is charged to cost of sales. They will always tell you where you should take it to. They will always, every diet. So don't bother about them not telling you where you should take the depreciation to. They will always. So reducing balance. You will see that when they gave us depreciation rates, they tell us they would always tell you the method of depreciation. Reducing balance. They could tell you straight line, whatever they must tell you. They now said, while depreciation on all motor vehicles is 20% per annum straight line, charged to distribution costs, they will tell you. They now said depreciation is charged in full in the year of acquisition and no charge in the year of disposal. You see, this statement is powerful. If you get it wrong, you will have missed like 2 marks or thereabout, or even 3 marks, because depreciation usually, calculation of depreciation takes like 3 to 4 marks in the exam. So saying that depreciation is charged in full in the year of acquisition means that even if the asset is acquired during the year, don't prorate depreciation. Don't. And in any year when you dispose an asset, don't charge depreciation that year at all. The year you dispose an asset, don't charge depreciation that year. Okay? So they have given me 2 assets here: office equipment, motor vehicle. Olakule, go ahead with your question.
Yes, sir. So when you mean, that statement, when you mean don't charge depreciation in the year of disposal, is it on the part of the asset that is disposed or on the total asset?
The asset that was disposed.
Okay, sir.
Yes. Okay. So office equipment. And the thing is that a lot has happened to this office equipment. Speaking from note 2, where they sold an office equipment. So we need to be wary of that. And also note 3, where we manufactured an office equipment. That's an addition. So we need to also be careful about that as well. So a lot has happened to office equipment because we bought an office equipment, we sold an office equipment. So that being in my mind, I go to my next notes. I put it there, office equipment. I don't joke with this, my level of rounding off. I don't joke with it. Then I start. It's the same thing I've been teaching you. I start with the cost of the office equipment. I go to my trial balance, 86, 865, 800. It's always there for you in your trial balance. Look at it. Look at it here. Office equipment. This is the cost of the office equipment. 865, 800. So, I mean, you have to be opening your question and like just to ensure that you don't make mistakes. So the cost of the office equipment, 865, 800. Additions. Don't forget, there was an office equipment we manufactured that they went to add to cost of sales. Of course, in these workings, we have told them to remove it and that we should add it to office equipment. So this is the adding it to office equipment. It is 2600. So we are adding it to office equipment. They also sold an office equipment that they went to put in revenue. Now we say, no, it should not be in revenue. But yeah, disposal. What I removed is the carrying amount. A lot of students that died removed the money they received from the sales instead of removing the carrying amount from here in this schedule. So this is a very important knowledge. I mean, the examiners, the comments, the feedback we got that diet was very disappointing in the sense that why would students not know? Because we have taught you already that when you have like a fixed asset schedule, this is a schedule. What goes there is the cost of the assets. If you bought any additional asset, you add the cost of that. When you sell an asset, what you remove should in fact be the carrying amount of that asset that you sold. You remove it. You remove it, which is the cost minus depreciation. That's what you remove when you sell. Not removing the money you received from your cost table or from your fixed asset schedule. So this is something you need to understand very well because they will still ask you. So you need to know that from your fixed asset schedule here, the opening, the assets you bought, the disposal, what you remove is the carrying amount of the asset disposed, not the sales proceeds. Please note that. Is the carrying amount of the asset disposed you remove, not the sales proceeds. Please hear my words. Then I would remove the opening accumulated depreciation of 199,800. And of course, you know that this will be given to you in the trial balance, the opening accumulated depreciation. Let me show you. My accumulated depreciation, this is my office equipment. It should be on the credits. This is the opening. So 199,800. So I carefully remove it from here. So what this is giving me is my opening carrying amount. My opening carrying amount. Having determined that, I will then charge my depreciation. In the additional information, I will go back and confirm again. Is 15% on reducing balance. That means it will be 15%, 15% on the opening carrying amount. Yes, Prudence. Sales proceeds only show in the disposal account. That is all. Very good observation. Yeah. So 15% on the opening carrying amount. That is what gives me this. And that's my depreciation for the year. And I quickly put cost of sales. And that's how you should do in the exam too, so that you will know. Because it's from your workings, you will start putting these figures where they belong. This depreciation charged, they told me in the additional information that I should add it to cost of sales. Look at it here. Office equipment depreciated, it should be charged to cost of sales. So I note it so that I won't forget, because I can't assume I will remember. I quickly put it in front, cost of sales, this. So when I remove this from my opening carrying amount, then I get the carrying amount at the end of the year, which is 597,159. So in all of this, two things I need from here. Number one, depreciation. It goes to my P&L, cost of sales. Number two, my carrying amount. It goes to my statement of financial position. Those are the two figures I need. But if you don't methodically do this very well, you would be wrong. So, you see, the good thing about this question is that it has shown you all. When you understand this one now, there is no whatever that you'll not be able to adjust for. Because this one has shown you a situation when there is an addition during the year and when there is a disposal. And now you have learned that when there is a disposal, what you remove is the carrying amount of that asset disposed, not the sales proceeds. You have learned that now. So if they bring it out again, something you should be able to tackle. Then they also told me about motor vehicle that I should depreciate it. The same process. This one is straightforward because there is no addition, there is no disposal. So I get the cost of these assets. Even though you will see in the additional information, they said motor vehicle, 20% on straight line. But if you check in the trial balance, they didn't call it motor vehicle. This guy decided to call it delivery van. So it is left to you to know that it's the same thing. It is left to you to know that it's the same thing. Okay, Olakule, you can ask your question.
Okay, sir. The adjustment we just did to office equipment,
Okay.
can you just oppose it with what is in the additional information where it mentioned that depreciation is charged in full in the year of acquisition and none in the year of disposal?
Okay, good. So, now, if the examiner didn't tell me that, this my depreciation the dynamics will have changed entirely. The dynamics will have changed. Because what I will have done is that, you see, this addition, I bought these assets during the year in February, 1st of February 2022. I'm not going to have charged full year depreciation on this one. I will have prorated it from, I will count my hands. I will say February, March, April, May, June, 5-month depreciation. So you will have find that, just sorry, this is to Olakule like that, but let's see if you guys will get it. So what I will have done is I will have done depreciation on that addition. On the addition, I will have done, because it's a new asset, I will have done 15% on this addition. which is 82,600 times 5/12. I will have gotten that separately. Then the assets, the other assets, since it's on reducing balance, I will have done 86,800 minus 46,060, the asset that was disposed, minus I'm just trying to do it as minus 199,800. 199,800. I will have gotten 6,199,50. So I will have done depreciation on other assets. I will have done 15% times 6,199,940. That one full year depreciation, because the asset has been there from the beginning, times 0.15. I will have gotten 92,991. So I will have done the depreciation like this. I mean, the examiner is just trying to be kind to you. That's why they say that even if you buy an asset during the year, charge full year depreciation, so that you won't find yourself in this situation where you will have, because you will have to do depreciation for that addition separately, so that you can prorate it, because you bought it during the year. But in this case now, since you are not required to prorate, that means these two steps is now into this one, just one. So you just need to apply 15% on the opening carrying amount. So that has already taken care of everything like that. Just apply 15% on opening carrying amount. Okay, I hope I was able to just oppose as requested. Okay. So let's move to the next one. Motor vehicle. The cost of the motor vehicle is this, as given in the trial balance. The opening accumulated depreciation is this, right? And the question told us that depreciation on the motor vehicle is on straight line basis. So I apply 20% on costs. On cost. If you punch your calculator, it gives you this. And the question told us that it should be charged to distribution. If I cumulate these three, my carrying amount is this. See, from this I've done, all I need is my depreciation goes to P&L under distribution cost. And this is my carrying amount that will go to my statement of financial position. And all the information is just available to you. You already told me everything. Motor vehicle, 20% per annum, straight line, charge to distribution. So I know for my trial balance, they will give you the costs, even though they called it delivery van in the trial balance. I get that. My opening accumulated depreciation, I remove it. Then I charge my depreciation 20% on cost. Okay, so I want to believe you understand this now. So somebody will ask the question, that's 5-month proration that I did. So it doesn't really concern this question. He's just curious. So I have to answer him. So the office equipment here, we manufactured an office equipment that we put to use in February, right? And I already know that the year end is June. So from February to June is what my depreciation would cover. February, March, April, May, June, 5 months. That's it. I hope I was able to answer your question. Okay, the next one, which is note 5. So you see that note 1 to 4 is almost all about depreciation. They're just going here and there. So it's an important part of your Note 1, all that knowledge you got on PP, like, is very important. So let's go to other areas. He said, following the conclusion of the winding up proceedings at one of Adama's, it was resolved to write off a sum of 26.4 million due from customer. This is so straightforward. That's bad debt. That's bad debt. Okay, so let me quickly go back. Adetayo. So the motor vehicle, there is really nothing new here. So I don't know which part of it you didn't get. So they told me they depreciated the motor vehicle 20% on straight line. So the same thing I've been doing, I get the cost of the motor vehicle for my trial balance. It's there in your trial balance. Even though they called it delivery van here. See it here. Yeah, this is the cost. This is the accumulated depreciation, 125.60. So the same thing we have been doing, costs minus opening accumulated depreciation. Then I charge my depreciation for the year, 20% on costs. And that gives me this. Then deduct this and this from your cost. It gives me my carrying amount. So, yeah. So now, going back to the next one. So I'm writing off 26.45 from a customer, due from customer. This is bad debt. This is bad debt. And this says that you should make an allowance for receivables of 2.5% on the continuing receivables. So the ones that are remaining, make an allowance. This is similar to make a provision. This is similar to estimate that 2.5% of them might not pay. Might not pay. So, I mean, it is as simple as it is. Like, write off these from your trade receivables due from customer. So if I go to my trial balance, where is my trade receivables? Where is it? Where is it? Where is it? Okay. Trade receivables and payables. Of course, you need to know that the one on the debit is trade receivables. The one on the credit is trade payables. I hope you know that. So this is my trade receivables. So out of these amounts, the examiner was very clear. Write off this. So write it off. Take it off. Deduct it from it. That's one. Two, in addition to taking this off, you take off additional 2.5%. Even though the way we describe it in accounting is allowance for doubtful debts. I mean, the examiner was very clear. This one is bad debt. This one is an irrecoverable debt. It's gone. I'm just trying to keep it simple. Write it off. Remove it. And in addition to removing this one, it says also make an allowance for receivables of 2.5%. Meaning you are going to remove additional 2.5%. Look at it. Let me show you. So I keep it simple. Trade receivables. I put my currency. This was my trade receivables in my trial balance. Bad debt. Bad debt. I take it off. I take it off from my trade receivables. And you see, I know that it has two legs, right? One leg is taking it off from receivables. The second leg is going to P&L as an expense. So I put it in front, P&L. You will see, I'm not showing my debit and credit skills. I'm not saying debit this, credit that. I'm not doing that. I took it off. And in front, I told the examiner that, okay, it goes to P&L too. That one. Whatever is remaining, I also take off additional 2.5%. I call it how the examiner has described it. Allowance for receivables. So 2.5% of this. I get this. I take that two off from here. Again, you need to know that this one too will go to P&L. Two treatments. Joy. Don't let it scatter. I mean, this is as it is. It depends on your view of it. Keep it simple. So it's clear. It's just so clear. Following conclusion of winding up proceedings, it was resolved to write off. Write off. I mean, it's as simple as remove it from your receivables. Just, I mean, focus on the removing it. Write off. Focus on that, as the examiner has actually told you. So write it off. Don't overthink it. It becomes a problem. Write it off. And also to make an allowance for receivables of 2.5%. Is this one too means removing it again from receivable, removing an additional 2.5% of your receivables balance. I mean, of continuing trade receivables, of whatever is remaining. It is like that. And the thing is that diet in, diet out is always like this. So I don't think it should, anything anywhere should be scattered. And in keeping it as simple, that's all I've done. I got my trade receivables in the trial balance. I removed it. I removed the bad debt. I removed it. That's all I've done. And I noted that, okay, it's an expense too. Anything in the additional information has two effects. This is the two effects. One effect is I'm removing it from my receivables. The second effect is it's going to go to P&L also. Whatever is remaining, the examiner said, okay, charge 2.5% allowance for receivables. I don't want to start bugging you about, okay, what it means. This is what, allowance for receivable is saying that I'm just estimating that additional 2.5% might not pay. So that's the difference between bad debt and allowance for receivables. Bad debt, this one is gone. What's the law? This one is gone. They are not paying back. Even though they can come back, but I've written it off. But this one, they might still pay back. Okay, that's the meaning. But treat it very well. They might still pay means remove it first. Let's assume that they might not pay, right? So remove it in such a way that the balance in my receivables is just this. It's just this. And I know that it must have two entries. So one leg is removing it from receivables, the other leg is taking it to P&L. That is not more than that. It's not more than that. And because I know that in the exam, right, this diet was particularly quite easy. Okay, this is really all you would do. But in the previous diet, I saw that they will also give you allowance for receivables in the trial balance. So if they pay later, then fine. So that means you add it back to your receivables. You add it back to your receivables. Yes, now they have paid back. You add it back, you remove it because now they have settled. Okay, so we really call that bad debt recovered. Okay, and the double entry for that is you are debiting bank and you are crediting other income. That's the right thing to do. When something that has been bad, they come back and pay back, don't add it to your receivables, take it to other income. It's actually other income. Okay, again, as I was saying, the only reason why I'm adding this is just preparing for the next diet question or another question we're going to solve. Because I see that they will give you allowance for receivables in the trial balance. Okay, so that would really be my opening allowance for receivables. While the one that I computed this year, okay, is my new balance for allowance for receivables. Okay, in this case now, they didn't give us. I'm just giving you this one down in case you find it in another diet. So when they give you opening, what goes to P&L is not this total amount that we computed here, even though it's the total you remove from your receivables. You have to remove it from your receivables, but it's not everything that will go to P&L, which is why I didn't write this there before. I just wrote it now, right? I just actually wrote it now because we didn't have any opening. But if you had opening of this allowance, it will be in the trial balance. Whatever you have computed up there is now the new balance, is the closing balance. Is the increase or decrease that goes to P&L. In this case now, no opening. So everything goes to P&L of this amount. Okay, so I could have easily stopped here, really. Then, and that's it. And I also give you some notes here for you to write. That's that for this. Keep it simple. So the next one, the financial assets are equity. Yeah.
Please, question. I just want a clarity on this. So you're saying that assuming there was no balance at all for the provision in the trial balance, we can use the whole of the value. But if there was a previous balance, whatever that was calculated on top now, that's what we're expensing in the P&L account.
Is the increase or decrease that goes to P&L.
Okay.
Like I've shown you here. So if that giving you opening balance, then you have a new balance. Is the difference between these two that will go to P&L.
Okay.
You would see there's in the diet before this one, that was how they asked it. So
Okay.
yeah, in this case now, is this entire money that goes to P&L because we don't have any opening.
Oh, okay, sir. All right. Thank you.
Yeah. Latif.
Good morning, sir.
Hi, good morning.
Okay. Sir, that of the increase in provision, in the balance, in the statement of financial position, would there be any of the two that will appear there that will be less from the receivable?
Because I've already done that, yes. So this has already taken care of everything. You see that I've already removed it from receivables here.
Exactly.
So
Exactly.
from here, I've already
Hello,
done
sir.
everything that I need to do. So this is my receivable balance. This goes to P&L. This goes to P&L. So everything is
Hello,
done.
sir.
Yes, Obafemi.
Yeah, I think the question is trying to ask is that the increase and decrease of that allowance, if we want to remove it from this bad debt, are we removing the entire money or the increase of or the decrease?
Increase or decrease has nothing to do with this. Okay.
Okay, just the total that we removed.
Yes. So the increase or decrease has everything to do only with P&L. Okay. Only with P&L. So the only reason why I even added this is because I'm just preparing you for a situation where they will give you opening balance of receivables. Okay. Then you compare it with whatever you computed up here. Right? Is the increase or decrease that goes to P&L.
Okay.
But what you
Thank you, sir.
remove from your receivables is this one, everything, not increase or decrease.
Okay.
That's what you remove from your receivables. So here, financial assets are equity instruments held at fair value through P&L and have suffered impairment of this. Keep it simple. So everybody here knows what impairment loss is. It's like also a write down in the fair value of an asset. So that means write down this financial asset value by this. So if I go to the question, this is the financial assets. 244,200. So write off what they ask you to write off from it. This. Write off 12.7. That's all. So I go to my workings, financial assets. In my trial balance, this was the value. This was the value. Write off the impairment loss. Then the fair value is this. Right? So from here now, I know that this is the balance of my financial assets that will go to my statement of financial position. And this impairment loss that I've written off, it will also go to P&L too. That shows that I've already treated this one twice. This 12.7, I've stated it twice already. The first leg, I deducted it from financial asset. That's the first leg. The second leg, I took it to P&L. That's it. For the financial assets, keep it simple. The next one says that the 3% says that the 3% redeemable loan notes were issued on October 1st, 2021 under terms that provided for a large premium on redemption in 2005. The terms were interpreted by finance director to mean no notes have an effective interest rate of 6.5%. Okay, so I taught you this very well in financial instruments. So there is a redeemable loan note. There's a redeemable loan note that we collected on October 2021. That's during the year. Because the end of the year is June 2022. So that's the year actually borrowed this money, or the period is particularly important. You will see very soon. And they said that I borrowed this money under terms provided for a large premium on redemption. For a large premium on redemption. So I need anybody in this class to tell me, what does it mean to have issued a loan note and there will be a large premium on redemption? What does that mean? Anybody? Taught you this
Come
before?
again, sir. Please come again, sir.
So I took a loan, I borrowed money, and from the question they said under terms that provided for a large premium on redemption. What does that mean?
Does that imply long-term loan?
No.
So does that mean that the total amount we paid at redemption will be higher than the amount borrowed, the amount borrowed? Right for that. The face value.
Lekon, that's absolutely correct. That's absolutely correct. Thank you very much. At least somebody actually got it. Even though Joy was saying that you will pay with shares. Shares in Coco simply means the loan will be redeemed at premium. Yeah, that's correct. That's exactly what it is. So at premium means that, let me show you. Where is the loan again? Yeah. At 3% redeemable loan notes. This is it. 843,000. So it means that when it's paying back, you'll be paying back, like, let's say 850,000. You'll be paying back, like, let's say 850,000. That is paying at a premium. It's paying at a premium. So, and I taught you this when I gave you an example of he borrowed 10,000 and he's going to pay back 11,000, like that. And I told you that difference of 1,000 is premium. I can remember very well teaching you that. So, which is exactly this. And I told you that when that kind of situation happens, the interest, this 3% interest, is not the only interest is earning anymore. Not earning in this case, it's paying. It's not just 3%. It's paying much more. It's paying much more. That was when I told you they will give you an effective interest rate. So, and I remember we used 8.08%, right? In this case now, it's because of the premium. That's why they are giving you effective interest rate here. Because the interest is beyond just this 3% alone now. It's beyond 3%. Because of the premium too is an interest that we're going to spread over the life of the instrument. Let me just close this, my WhatsApp. It's making noise. Yeah. So this is how the question comes in the additional information, most of the diets. So how do you immediately deal with this? Very straightforward. It's always like this every time when you have the question constructed in this manner. So look at it. You just do that amortization schedule that I taught you in class. You get the opening balance, which is the figure in your trial balance. You add your interest payable. This is the effective interest, which is 6.5% multiplied by the opening. So that will give me the interest per annum. And I have to prorate. So a lot of students didn't prorate this diet. They didn't prorate, right? They forgot that the end of the year is June. The end of the year is June. And this guy took the loan in October. This guy took the loan in October. So October to June is 9 months. So they just did the full year. A lot of students knew this because it is a common question that I can ask. Many students knew how to do this, but they didn't know how to prorate. They forgot, not that they didn't know. They actually forgot. Please don't forget. So 6.5% times the nominal value prorate, you get this. This is what goes to P&L. The effective interest is what goes to P&L. However, even though this is the interest accrued, but the interest that will actually be paid is the fixed interest. That's the agreed interest. So interest that is due for payment is 3% times 843. Of course, we prorate that too. We get this. So this is the balance. So in all of this I've done now, this goes to P&L, the effective interest, and this is the balance of my loan that goes to my statement of financial position. Okay, having done that, you have to be very careful because there's an element of accrued interest here. What do I mean? This is the interest that is due, right? This is the interest that should be paid, this 3%, which is 18,986. Okay, that's the interest due. But I told you in the last question that if they give you interest paid or if they say interest in the trial balance, because the examiner actually gave us interest in the trial balance, interest on loan notes, this one. I explained to you that this is the interest that was actually paid. This is the interest that was actually paid. I told you. So since the interest that should be paid is that 3%, that's the fixed interest, is the 3%, is 18,968. But what they paid is 14,763. So that means there's an accrued interest that will show in my current liability of 4,205. So that's all for this one. Happiness, you can ask your question. Okay.
I didn't get the one you said is going to be P&L. Is it the accrued interest or the balance?
Okay, so whenever you have this amortization schedule, right, what goes to P&L is the interest payable, the effective interest. The effective interest. Then establish that first when you have to do something like this. The effective interest goes to P&L, which is why I wrote P&L in front of it. That's first. And the balance here goes to your statement of financial position. So that's that. However, in the trial balance, they give us interest. That interest is what the guy has paid. But the interest that should be paid is the 3% fixed interest, which is the 18,968. So there's an accrued interest, there's an unpaid interest of 4,205.
So
Okay.
the unpaid interest will now go to current liability, right?
Yes, current liability.
All
So,
right,
and
thank you.
again, okay, go ahead, Charles.
Yeah, so is it every question that we come across that
I can't hear you.
is it every question that we come across that they will tag it as effective interest rates?
Well, the one of last diet, they didn't bother giving you effective interest because they didn't tell you there was a large premium.
Okay, so which one will be going to PLL if we weren't given that one?
Is the normal interest we are paying.
Interest pay.
Yes.
Okay. Thank you.
Yeah.
So I have a question, please. So this is 3% redeemable. Assuming, or would they sometimes would they ask if it's convertible loan?
Yes, they can say convertible. It doesn't really see much. It's still the
Okay.
same treatment.
Okay.
Okay.
Just like this.
Yes, just like this. So anytime they give you effective interest rates, every time you have to do this. You must know how to do this amortization schedule every time. So if they don't give you effective interest rates, then the one we did last, that of the one we did on Thursday will surface. So is this fixed interest that goes to P&L, and you also do accrued because you have to compare that fixed interest with what was paid in the trial balance. So that there will be accrued that will be under your current liability. And don't forget that the reason why we prorated this 9/12 here is because this loan was issued in October and the year end is June. That is 9 months. So we cannot put the entire 1 year interest in. We cannot use the entire 1 year interest. We have to prorate it by 9 months. Okay, because they issued the loan notes in October. 1st of October. So that's that for this. Then we're told the income tax expense for the year ended June 30th, 2022 is this. This is the current tax. While the deferred tax for the same period is this. There was an over provision of this. Okay, so again, this is a wrong construct of a question, right? Over provision should not be in the additional information. Over provision should be in the trial balance because it's something that has to do with last year. So it's just saying that, okay, last year we overpaid tax. So it's going to be a balance in the tax account from last year. I don't know why the examiner decided to do it this way. They just messed up everything. But the only way we do it is this. Ordinarily, if they had said this question the right way, this 25,664, it will be, they will call it current tax. They will now put it on the credit side of the trial balance. You will have, if you have been solving these things, you will have seen it. They will call it current tax. They will put it in the credit side of the trial balance. It's a balance from last year. It means we over provided for tax last year. We over provided for tax last year. So all we just need to do is to remove it this year from our tax estimate of this year. We just remove it from our tax estimate of this year. That's how we deal with it. So, but in this case now, this is my current tax for this year. Let me show you. Look at the way you would always do it. So I have current tax. They gave me over provision in the previous year. You see, I did minus. Then estimate for the year. I put this on there. I get a balance of this. You see, the right thing is that this estimate for the year is what I'm owing this year. That is what should go to my statement of financial position. And the balance here is what should go to P&L as my income tax. But because these guys gave me this over provision in the additional information, that means I have to treat it twice. Otherwise, my account will not balance. And that is why is this balance that is going to my financial position and P&L. A lot of students, because what we taught you guys is that over provision will or should always be in the trial balance. So a lot of our students, they actually got these workings correctly, so they picked point from that. But when they were preparing their statement, because we have told them that is the estimate for the year that goes to financial position, so they put this 143 in financial position. They now went to put this one in P&L. The account didn't balance. It won't, because you have not treated this one twice. So giving it a true impact is why this is what will go to P&L and financial position. Even though it's technically wrong, right? But because this guy didn't put this figure in the trial balance, we have to treat it twice. So it will go to P&L, it will go to statement of financial position. Okay? So this 117888 will go to P&L and will go to statement of financial position. Because they gave us the over provision in the additional information. If they had done it the right way, it should be in the trial balance. They will call it current tax. It will now be on the credits. That's over provision. So you will have done it this way. You will have removed it from the estimate for the year. But the right thing is that it's the estimate for the year, is your tax for the year. That is your liability for the year. That's what should go to statement of financial position. Then whatever balance you have here is what goes to P&L. But it's because of the way they just did it. That's why we have to take these two. Otherwise, the account will not balance. That's one. Number two is deferred tax. The examiner gave us a deferred tax, that the deferred tax payable is this. That's the deferred tax for the year. In this case now, they now gave us a deferred tax in the trial balance, which is this. That's the opening deferred tax. That's our opening deferred tax. So, just the same way, I get my as per trial balance, which is the opening deferred tax. The estimate of the deferred tax for the year that was given in me in the notes, in the additional information, which is this, is the estimate of the deferred tax for the year. That's my liability for that year. That's what goes to my statement of financial position. While the increase or decrease goes to P&L. In this case now, the opening was 100. The estimate is this. So there's a decrease. It decreased to this. So 877,558. So that decrease goes to P&L. Because this one is like a decrease in liability. Because my liability was 100,000 before, but now it is this. So it's a deferred tax income of this. So from all of this now, what goes to my P&L as income tax? Number one is the current tax expense, which is this. This arising from a liability, so is an expense. 117888. I aggregate it with my deferred tax income. So because this one is coming in as an income, as a decrease in liability, so that's why I'm deducting it. So what goes to my P&L aggregation is this. So income tax is an aggregation of current and deferred tax, but you need to carefully work it out. My current tax, I aggregate my over provision with the estimate for the year, I get a figure. So this two goes to statement of financial position, while the other one goes to P&L. My deferred tax, I compare my opening, which is the figure they will give you in the trial balance on the credits, with my estimate for the year. So the difference is the increase or decrease that goes to P&L. Since this is a decrease in liability, is a deferred tax income. It's now been deducted from the expense. So I get this. So this goes to P&L now. That's the income tax expense. Then the suspense account balance represents the corresponding credit entry for shares issued at premium of 15 kobo per share arising on the issue of 100,000 ordinary shares made during the year. So there's a suspense account balance. They said it represents the credit entry for shares issued at premium, 15 kobo per share, arising on issue of 400,000 shares. So if you do 15 kobo times 400,000, it should be around 60,000. So let's see. Okay, so there's a suspense account here, 60,000. So what this note is actually telling us is that that suspense account is a corresponding credit for this premium. So that 60,000 that they took to suspense account, it should go to share premium account. So I have to take it from this suspense account. I'll go and put it in my share premium account. I'll go and put it in my share premium account. So I go to my workings. So I deduct from suspense. I add it to share premium. I deduct from suspense. I add it to share premium. That's all I do. And that's all for this. So again, for this tax, the examiner gave us the estimate for the year and he gave us an over provision. Over provision will always be deducted from the estimate for the year. So we would get this. So this 117,888, we took it to P&L and in the statement of financial position. Okay. So that's why this actually comes here as part of our current tax expense. So when you see over provision, you remove it from the estimate from your liability for the year. Then we talked about deferred tax. You just compare the opening with the closing. The opening is the one in the trial balance. The closing is the one that will give you in the additional information. Now that's the closing deferred tax. So this closing goes to my liability, specifically non-current liability. Then the difference in this case is a decrease in deferred tax. It will be an income. Is a decrease in liability. We call it deferred tax income. That's why it's being deducted from here. So that we're having our income tax that goes to P&L as this. So that's like going over it again. Okay. Olakole.
Yes, sir. It's still on the income tax. So I just want you to please go over the over provision again. If it was included, I understand because it was included in the additional information, but if it was included in the trial balance, my understanding is that it should still have gone the same way as we have it here, except I'm missing something. So please, I want you to explain again, sir.
Okay, so if it was included in the trial balance, okay, you will have still worked it this way, okay? But is this estimate for the year that will go to statement of financial position, while this one will go to P&L, which is the right thing to do. This one that we have done, I can tell you for free, taking this one to financial position is wrong. Is wrong. Very wrong. Very, very wrong. But unfortunately, the examiner is who is putting us in this position because This is my liability for this year. This is what I'm owing this year. And that is what should show in my statement of financial position as what I'm owing this year, not this one, not this. But because of the way this question is structured, I just have to put this to P&L and also to statement of financial position. Just because this is the first time they are setting it this way. I've never seen anywhere. It's wrong to set it this way, to put over provision in the additional information. It's wrong. It should be in the trial balance. So just take it this way. The right thing is this one should be in the trial balance. Then you would always do it like this. Then this estimate is what you are owing that will go to liability, while this one will go to P&L. But just so that our account is balanced, that's why you're taking this to P&L and financial position.
Thank you, sir.
Yeah. Finally, the directors recommended 20 kobo final dividend. You do nothing to this. Recommending dividend, it doesn't mean you have a liability yet, that you should go and recognize that dividend in your books. That's not the final agreement. Shareholders must ratify, must approve. That's the final stage before you can then go ahead and recognize it. For now, do nothing. But there was a transfer of 38.9 million to general reserve. All you are doing here is moving it from retained earnings to general reserve. That's all we're doing here, which is what I did here. So I deduct from retained earnings. I added to my general reserve. You see, in all of my workings, I'm not doing debit this, credit this. It's just, I would advise that's what you do in the exam too. Where you should deduct, where you should add. And that's what you should tell the examiner. So they say transfer to general reserve. So I'm deducting from retained earnings, adding to general reserves. Okay, so now I'm done with all my workings. Now I just need to put some things together so that when I'm preparing my statement, it will be easy. So what I usually put together, majorly popularly, my cost of sales, my admin, and my distribution, I put everything in one place. So starting with my cost of sales. Yes. So starting with my cost of sales, so in my trial balance, I was given my cost of sales as 995,003, right? 995,003 in my trial balance. This 995,003. Then there was some items that I said depreciation that goes to, like this field that goes to cost of sales, like this assets that we capitalize that we need to remove to cost of sales, like this depreciation of office equipment that will go to cost of sales. So all of that we need to put them together, otherwise we'll forget. So the only way we have to do it is to put them together in our workings here. So as per my trial balance, I have this depreciation on land and building from note 1, this amount, depreciation on office equipment from note 3, this amount, and the capitalization of expense that they added to my cost of sales, I need to remove it from here. So when I cumulate all of this, I get this. The same thing for the admin. So as per my trial balance, I have this in my trial balance. Then depreciation on the land and building from note 1 that goes to, that I said it should go to admin. The bad debts that I removed from my receivables, bring it to admin as an expense. my increase in allowance for receivables to admin, the impairment of financial assets, I add it to admin. Then this is the
Sir?
Yes.
Okay, and these are administrative expenses.
Okay.
Apart from the depreciation on land and building that we were told that we should put it on admin, can we make bad debt increase in allowance for receivable and the impairment of financial assets? Can we make all those one as a standing alone item in the statement of our profit or loss account?
Yes, you can do
Instead
that.
of bringing it under admin.
Yes, you can actually do that.
Okay.
But the thing is that you might now forget. So just put everything together as one classification instead of doing it like just putting every item on the face of the account like that, which is technically wrong. So it's better, but if you put it on the face of it for your exams, you are fine, you are okay, nothing.
Hello, sir.
Yes, let me talk about.
Yes, sir. In some questions that I've seen, this increase in allowance for receivables and bad debts, they usually put it under distribution.
That one
I
too
don't know
is
if that is wrong. Okay.
that one too is okay. So
Okay, sir.
those are areas of judgment in reporting. So people, depending on your judgment and your explanation, so we're not going to take that against anybody.
Thank you, sir.
Yeah. So distribution expense, the same thing as my trial balance, my depreciation on delivery van that they said I should add to our distribution. So I have a total of this in my books. Then my other income, don't forget that profit on disposal of assets that we got in the note up there. I immediately put it here. And if you want to put it as a separate line item, it's also okay. But I just want to arrange my work very well. Then my finance costs. I know that is that my effective interest that comes to P&L as finance costs, the one I did here. This one. This is my effective interest rates. 41,096. I put it under my finance cost here. Then there was an investment income. There was an investment income, which is this. 65,246. You will see that in my trial balance. Investment income. 65,246. So I just intentionally put it so that they know that, okay, finance income is relating to that. So that's it. Then I prepare my statements. I've already done all my workings. Preparing this statement is just simple. My revenue is already in my note 2. I've already done it. My cost of sales, I've already worked it out. I get my gross profit. My other income, I already showed them that in this note 15 also, 23,190. My distribution, I've already worked it out for them. My admin is already there. Everything is there. I get my PBIT. My finance income, I've already shown it. My finance cost, then I get my PBT. My income tax, I've already shown everything. So preparing this statement is just easy because I've done the right thing. The same thing, after your statements of P&L, the next thing is equity. And from the last class, I told you that your equity, this one has a lot of headings here. Share capital, share premium, retained earnings, reserve, gain on translation, general reserve. How do I know I will have all these headings? It's for my trial balance. It's for my trial balance. Starting from this, where's my share capital? Okay, so they give me share capital. This is my share capital, 790. This ones didn't arrange it. They just scattered it for these guys, these guys. this guy is a sadist. So he puts gain on translation here. And gain on translation is a reserve too. It goes to equity. Just cut out everything for you guys. That's just right. Then there's general reserve, is equity. There's retained earnings, is equity. There's revaluation reserve, is equity. There's share premium, is equity. So all of those figures are those you would come and put in your opening statement of statement of changes in equity. All of this. It constitutes your opening. So for the share capital, since there was no share issue, the only thing was just this suspense. This suspense that we moved to share premium of 60,000 that we worked up there. This one, this particular one that I deducted from suspense, I added to share premium. So for my retained earnings, what increases my retained earnings is my profit for the year. And this is my profit for the year. That's for my statement of profit or loss. And there was a transfer to general reserves. So I transferred 38.9 from retained earnings to general reserve. Okay. And there was dividend paid. That what you get from the trial balance. Dividend paid. Where is it? There was dividend paid. This one, 119,880. So I put it in my statement of financial position, statement of changes in equity. I removed it from my retained earnings, dividend paid. And as I'm putting these figures, I'm extending everything to my totals here. So if I add everything together, I will get my total of one.
Sir, this transfer note, sorry, sir.
Yeah. This one?
This transfer note, yeah, note 11. It doesn't have any effect on the total.
Yeah, because it's in and out. So I removed from here. I added it here. So it's nil.
Okay, sir.
It's in and out.
Thank you, sir.
Okay. So my statement of financial position, my land and building, we always start.
Sir, before we go to statement of financial position, sir.
Okay.
Now, our statement of profit or loss and other comprehensive income, is it because we don't have item of like revaluation gain or so that we didn't do anything as per the other income statement?
Yes.
Because we did our working to profit for the year.
Yes, because we don't have any revaluation surplus for the year. The only revaluation surplus we have was the one in the trial balance, and that one is opening. It comes as opening in the statement of changes in equity. So because we don't have revaluation surplus for the year, that was why we stopped at profit for the year.
Okay. Thank you, sir.
Yeah. Olakule?
Yes, sir. Note 6 says that financial assets are equity instruments. And I'm wondering, or maybe not, why it's not also included as items under statement of change in equity.
Oh, okay. Remember that under IFRS 9 that I taught you, financial asset is either cash, equity instrument of another entity, or contractual right to receive cash. So when they say equity instrument, they are talking about equity investments. They are not talking about your own share capital. They are talking about you buying shares, you investing in another company. That's financial asset. So yeah, what comes to equity, yeah, your share capital and reserves. That one is an investment, financial asset. That shows you have forgotten most of what we taught you. Okay, so Adama, you were asking that you thought profit on sale should be other income. Yes, we treated it as other income. Here, I already put it here as other income in my notes, note 15, and it's already here too. I already put it on under other income. The profit on sale of assets. I already put it there. Okay, so my statement of financial position, this one too, very easy. This one too, very easy. My freehold land and building, I already did the notes. So I'll just pick it from my notes. My office equipment, pick it from my notes. My delivery van, pick it from my notes. My financial assets, pick it from my notes. My intangible assets, this one is from my financial position. Then is the total. Let me confirm that 5,600, the intangible assets. Where is it? Yeah, this is it. Intangibles, 5,600. So that's that. Then, having gotten all my non-current assets, then I have my current assets. So the first item under current asset is inventory. This particular day, they didn't even give you any note on inventory, so lucky you. Then after that, my trade receivables, 538,800 for my notes. Then my bank, 142,310. That one is from trial balance. And this bank, you have to be very careful. But I can see they give you debit and credit at the same time for bank.
One is bank overdraft.
Exactly. One is bank overdraft. This bank balance here. This one is the one that is the bank that will be in current assets, while this one on credit is overdrafts. Fantastic.
Liability.
Yeah, under current liability. So that's for my current assets. That's for my current assets. So by the time I add these three together, I get this 1.3 million. If I add that to my non-current assets, I get my total assets. I get my total asset. So my equity and liability. So this one, don't stress at all. Just go and dub it from your statement of changes in equity. Just go and dub it. Ordinary share, share premium, retained earnings, all of these figures. Just is the balance here, is the closing balance here. Just dub it. As soon as you have done this statement of changes in equity, when you get to the equity part of your statement of financial position, I mean, it's a walkover for you. So, and the total will still give you this. So, I just dub that one from there. I just dub it from there, everything. So, I get this total. So, my non-current liabilities, my 3% redeemable loan notes that I worked in note 8. This 86518,128. Let me confirm it. Note 8. Yes, this one that we did amortization schedule. Then my deferred tax is this one that goes to my deferred tax. My estimate for the year that goes to my deferred tax, 12,520. Let me see. Yes. I have my 3% and my deferred tax. Those are my non-current liabilities. So you need to always remember that deferred tax is a non-current liability item. Then my current liabilities. So I have my trade payables, which is this. I have my current tax. Current tax, which is this. And this is my current tax. Don't forget, we spent a lot of time explaining it to you. Current tax, this amount, this is what goes there. And I've already mentioned it that this is what should be. But because they give us this over provision and all of that, so it's a challenge for us. So is this 117 that goes to my liability? Okay, let me go back. current tax. This is it. Then my accrued interest, 4205. Don't forget that accrued interest that we worked here. These are accruals that you always compare how much you should pay with what they paid in the trial balance. So the difference is accrued interest. Then my bank overdrafts, that bank balance, the one on a credit. So when I add my equity plus my non-current liabilities plus my current liabilities, I get this. In this case, it balances up with my total assets. So my account actually balances out. So everything is perfect here. Everything is perfect here. In the exam, it might not be like that for you. It might. So if it doesn't balance, it doesn't really matter. So you just have to take heart and move on. Otherwise, you'll be spending a lot of time looking for what is not lost. I want to stop recording so that you can save this particular one on my laptop.